Good afternoon, everyone. We will be starting the presentation shortly. And I'm a Senior Marketing Associate here at Armanino. I'd like to go through a couple of housekeeping items before we get started. You can maximize or minimize the webinar pane during the presentation by using the red, orange arrow buttons in the upper left corner. During the webinar, we also encourage you to ask questions. In the webinar pane, you'll see a questions box that you can use to type your question and click submit. Our presenters will answer those questions as time allows during the presentation. Second, for good audio quality, please check your settings to ensure the appropriate audio option is selected. If you're using a telephone, please click on the phone call audio option. Or if you're listening through your computer, then please click on the computer audio option. To qualify for CPE, you must actively respond to all polling questions and stay on for the entire duration of the broadcast. If for whatever reason that you may have technical difficulties responding to the polling questions, please send an email to elevate@armaninollp.com with the name and date of your session along with your poll responses. You will receive your certificate within 5 business days. Also, please note as a participant, you will also receive a link to download the slide deck and the recorded presentation within 48 hours. Our presenters today are Jen McCabe, Scott Schwartz, and Isaac Peace. The learning objectives for today's webinar are to know how to prepare for a smooth and final year-end close, recognize legal changes in employee classification that could affect your business, identify filing deadlines and areas to improve internal controls and compliance, highlight best practices for policies and procedures, analyze the impact of recently issued FASB ASUs on private and public companies. Now I'm going to pass it off to Jen McCabe, who'll get us started.
Hi, everybody. I hope you're all getting ready for year end and already sort of into this. I'm going to cover the part here that everybody has to do no matter what is happening with your company. It won't be very technical, but it's a lengthy list. And if you're in accounting, you know already that it's a lengthy list. So the first thing obviously is look at your balance sheet, make sure that every single balance sheet has some sort of reconciliation. I always tell people to consider their balance sheet a to-do list. Everything on there is something that's going to need to be reconciled at some point. People at this time of year need to be looking at fixed assets and getting rid of stuff on the fixed asset schedules that's just old or gone or hasn't been touched in many moons. Get rid of it. It's time to face the music on AR, especially this year. If it's never going to be collected, get it off of there. And Scott is your person who's listening here about getting the cap table right. This is something you don't want to wait to do until it's all of a sudden time to do the tax return. You get it done and it comes back and you say, wait a minute, that's not right. We changed things around. So we'll talk later. I'm not going to be technical about leases and revenue recognition, but when there are revenue recognition policies to be dealt with, you got to get it right by year end if you've been forgetting about it until now. I'm going to really go into the payroll reconciliation a little bit more in detail. What we see over and over, and our auditors see it too, is that at the end of the year, people do not reconcile their payroll returns, meaning 941s, to the general ledger. So whatever is going to be reported on your 940 and your W-3 should be reconciled and tied back to gross wages on your financial statements. That's not me groaning, that's my dog. So I look at that, and what we see over and over is that middle of the year there was a bonus maybe that was done out of cycle or was done on a manual paper check, and it doesn't get on to the W-2. So go back and look at things where a paycheck was voided, someone was terminated and they lost their check and it had to be reissued. Be sure that those W-2s tie, because if you don't do that exercise now, you end up having to revise a W-2 and the 940s and the W-3s, and it's expensive and it's time consuming. The other thing on reconciling payroll is look at the way reimbursements were processed. What's popular these days and easy is letting your payroll processing company, your ADP, your paychecks, pay employee reimbursements. What we see quite often is that they've been set up incorrectly by the payroll clerk probably, and reimbursements are rolling into 401k eligible wages, for example. You want to make sure those things are correct. Let's see, estimated taxes are a big deal. So if you have an owner of a company or someone who is using their payroll to pay their taxes, you want to make sure that you're working with them. If you have someone who changes their W-4 every 5 seconds, make sure that they're okay. On the pass-through entities, LLCs and S-Corps, it's very important right now to make sure that that owner's personal tax strategy is being considered. So push the tax CPAs to be proactive so that whatever needs to be done, the S-Corps are the best example. Most S-Corp owners use their payroll to pay their taxes. So you might need to do a bonus to them and have it all go to pay their taxes. And the payroll people need to be working with the HR people who are also working with the tax people. Let me think about something. Okay, the NEC is this year. The 1099 NEC, we've had a lot of talk about this. We had a whole 1-hour webinar on just this tax form. The 1099 is different this year. So if you've been filing 1099 miscellaneouses for your entire career like I have, you need to adjust immediately. They basically, you won't use the 1099 miscellaneous form anymore, except for truly miscellaneous things. Lots of us use the 1099 to report non-employee compensation, freelancers, legal fees, things like that. When you pay 1099 non-employee comp, you now report it on a completely different form. It's called the 1099 NEC. That is where you will report non-employee compensation. Many software platforms have not adapted yet. Or you may be using an accounting software that has, but you're going to have to buy the upgrade or upgrade your software and get used to it so that you can do your 1099 NECs. We're here at Armanino, we are doing bazillions of 1099s for companies whose software has not adapted to this. So that's important. And the other reason it's important is that for the first time in my life, I'm seeing the IRS is actually charging penalties for incorrect 1099s. Many companies get a letter at the end of the year that says, hey, we got your 1099s, but you said Jen McCabe, when really her name is Jennifer P. McCabe on her social security number. So any mismatch of a social security or tax ID was kicking out this letter. They're now starting to charge penalties. So if you get it wrong, you need to fix it, because if you do it over and over, you keep 1099ing Jen instead of Jennifer McCabe, you're going to get in a pickle. The other thing is they are truly requiring electronic filing now. So it was very interesting. We have a client who got a fine for hundreds of thousands of dollars. They don't have tons of 1099s. They have about 500 to 800, but they got a fine because they didn't file electronically. And if you're required to, it's not a choice. They will, in fact, fine you and really hit you hard. So what this means now for all of you is that you need to get the email address of the persons that you're getting a W-9 from. The W-9 form doesn't ask for that, doesn't ask for the phone number, but you need their contact information, because you're going to have to electronically file these forms. And the easiest possible thing for you is going to also be electronically delivering the 1099 to the recipient all at once. It'll save you, it'll be more accurate. The other thing is, of course, you don't really want to rely on the United States Postal Service. I would think the recipients would be grateful for this, because they probably don't want their information in the mail as much as we used to think that was okay years ago. It might be nice to get it electronically. So update your 1099 information and think about the future and think about filing electronically, and be sure that you're ready for the new form, because this is going to happen. You need to be ready to do this in the next couple of weeks. All right, let's go to the next slide.
Jen, a couple of things I wanted to add just before we jump. The non-employee compensation piece, right? The 1099 NEC. You mentioned consultants, also advisors. Like you mentioned consultant advisors. I think board members, right? I think is another one, right? If you're paying any sort of board compensation or equity compensation, right? So if your board members get equity, or if you grant stock options to consultants or other third parties, right? That's another piece that comes in and is something important to consider as part of this process. And then I think you're going to cover it right here, but is also when you talk about the whole process around W-2s and 1099s, is understanding kind of where your employees are at, right, in kind of COVID times, right?
Yeah, so what's happening, and it's a little upsetting when it does happen, is employees are now, in some situations, allowed to go into the payroll system and update their address or update their W-4. And I thought that was super cool until this year. So this year, what's happening is when we go through the W-2 files with our HR and payroll teams and we look at these, all of a sudden we notice, hey, oh my gosh, Scott moved. He moved to Colorado and he just went into the system and updated his address thinking that was good. Well, what that means is that you now have an employee in Colorado and you need to have registered to be an employer in Colorado. And we are doing a lot of presentations about the unintended consequences of the COVID moves that are out there. What this means is you have this opportunity to look at your W-2s and see who's actually permanently moved. If they have permanently moved, you have to register as an employer in that state. And sooner or later, the employee is going to call you and say, why are you not withholding taxes for me properly? We hear from people pretty quickly on that if they move to Texas or Florida where there is no state tax. Even the temporary movers want that to be done. So really watch that. And I encourage you to have an HR policy that does not allow people to pick up and move without getting it approved. There's an assumption out there for whatever reason now that every employer will just let people move. That's not the case. If you're an employer, you hire someone to do a job at your headquarters and that's where they work. You do not have to keep them employed if they pick up and move. The assumption is not that that's what you have to do now just because you've let them do it during a COVID year. We are trying to get employers to do year-end bonuses now. The reason is that when people get their bonuses, lots of times they have questions about the withholding. You want to be able to answer the questions, and if you have to fix something or undo it, you need to have the time to do it. I mentioned shareholder payrolls, but I want to also remind all of you with S Corps that the shareholder health premiums need to be run through the W-2. If you have an owner on your payroll and you're paying their health insurance, that's compensation that has to be reported on their W-2. And while I'm at it, don't forget the ACA is out there. And if you have more than 250 people, you have to report the value of health insurance. In, I think it's box 12, there's a code DD that you have to put. So if you don't know what I'm talking about, now you at least know you have to do it. I mentioned reimbursements. I think I've got everything on the W-2 and payroll. I will say to everybody who's listening, if I just freaked you out because it's not on these slides, we're going to send you a checklist with these slides. So don't fret, it'll all be there. On that checklist, you're going to see that in 2020, there's some weird stuff. If you had Family First leaves that you paid because someone on your payroll was sick or their family was sick, you're going to have to make sure that's reported on your 941 properly. If you took an employee retention credit, those are fantastic, by the way. They're awesome, but you've got to report them on your 941 as well. Let me think. The retirement plan, I've got a checklist for you here. Make sure that's correct. You know, that'll get you in trouble with the Department of Labor. Scott, you talked about other crypto was a big one last year. Crypto appeared on the horizon, and oh my gosh, you've got to find a way to put that on the W-2. Now, let's talk for a second about flipping the switch to 2021. In the CARES Act, I hope all of you did that deferral of your Social Security tax. So every one of your payrolls right now, you're not paying your share of the Social Security tax. But you need to remember that you're supposed to start doing it on January 1st. And I would keep an eye on the payroll processors, make sure they do it right too. Make sure that you've booked that deferral correctly and that you will pay it on time. soon. And make sure you remember that it's due at the end of next year and the following year. And then make sure you reset minimum wage, because the minimum wage changes on January 1st. And remember, this is a big key, when the minimum wage changes for an hourly worker, it also often has impact on some of your salaried workers. Salaries are set at a minimum that's based on twice the minimum wage. So you need to look at your entire population and make sure no one has suddenly fallen into the hourly category as of January 1st. So plan ahead for that. Stop your deferrals and make sure you do your PTO accruals. And I think that's it on my checklist.
Yeah, I was just gonna, a couple of things I was gonna add, Jen, is the other thing to remember, you know, is if you're a if you do your tax returns on a cash basis, right, the deferral and the timing, right, is gonna be different. Not necessarily good or bad, but just something to understand, right, where you deferred maybe a bunch of 2020 expense, cash, right, that you didn't pay out, that you're going to have to pay out in 2021. So not necessarily, I mean, it's to me, it's a good thing. You should defer on an interest-free loan from the government. But when you are doing your 2021 planning, right, you're forecasting and you're estimating of costs, right, you have to make sure you properly account that that portion is going to be, you know, maybe 1.5 times or twice as large as it would be in a normal, you know, calendar year, because you have to pay that all back by 12/31/2021.
And it should happen organically if you've got this on your balance sheet and it's reflected correctly. One of the things I've recommended is if you've deferred your Social Security taxes, half is due a year from now and half is due 2 years from now. So I'm recommending people set up a short-term and a long-term liability account. That will help your tax people do some tax planning about when you'll actually be able to take that deduction Scott's talking about. Your balance sheet is really important to clean up this year of all years. All right, let's do one more slide. And the next slide is about the ABC test. Again, we've done webinars on this topic, and I've had to speak to the EDD in California about this. Last year, I went and talked to the EDD over 20 times for various clients. So I'm sure that you all saw the results of the election, in which Uber and Lyft actually managed to stay okay with 1099 workers. They've spent $22 million or something like that on that campaign. I can't remember what it was, but they've won that. So now there are exceptions to the ABC test, primarily in the creative industries, musicians, artists, producers, editors, anybody who kind of creates something that is a product of their own talent. They have some protections and don't have to necessarily go on payroll. But what I will say is the ABC test was meant to simplify this. It's just 3 questions. In California, they use this, and in 20 other states, this is predominantly the way that they decide. The worker really has to own and operate a business. That's all there is to it. So it can't just be me with my Social Security number. I actually need to have a business license or a website or something that indicates I have several clients, I intend to make my own money, and I'm not economically dependent on one entity. That's really important. Also, it helps if the work being performed by this freelancer is not a normal part of your business. So if we're Armanino and we're having an accountant come in and freelance for us, it's hard to argue that that's not an employee, at least in the state of California. And then, you know, this control test, A, is the first test. It's the old 20 question test bundled into one question. Do you boss this person around? Do you tell them what to do and where to show up? And it's so gray that it's not a good judgment anymore in many states. So if you have people who fall under this sort of problem area and you're worried that they really don't qualify to be independent or a gig worker in any state in the United States at this point, the Borrello test applies. So what that means is if they don't have their own business, really, you should put them on payroll. And the reason that's not bad, I used to cringe a lot when I said that and say, oh my gosh, it's going to cost more money. But in fact, it's not bad because when someone's on your payroll, you own what they do. you have the right to boss them around. If they do something creative for you, they write copy for you, you own it. There's no question that you own their output. So there are protections to you as well. It's not entirely horrid. But I wouldn't risk it, because when you get a 1099 audit, they audit all your 1099s and they audit them for 3 years. So right now we're talking about year end. The reason I'm bringing it up is that January 1st is a perfect time to change this. If you've been doing it wrong, as of January 1st, correct it. And the reason I'm saying that is that means you won't give one person, a 1099 and a W-2 in the same tax reporting year. That's a really obvious way to show the government that you don't really know what you're doing in classifying your workers. So if there's anyone in this gray area for you, flip the switch, change it, fix it as of January 1st, and put them on what we call temporary part-time payroll. And remember, it doesn't matter how long they work for you. It doesn't matter if they work for you 2 hours. It has nothing to do with the amount of time. It's just that your risk is lower. It has everything to do with what they do for you. This is a way to get in a lot of expensive trouble. The audits are very expensive. It's just not worth screwing around with. So I would advise you not to be aggressive about misclassifying a worker as a freelancer. I'm using air quotes around the word freelance, which I call the F word. Don't do it. Just go straight, because it'll save you money down the road.
And
I think
that's very PG. That's very PG for Jen McCabe, ladies and gentlemen. So, the one thing Jen, I was just gonna. I mean, I don't want to comment on that, because I think you're the expert by far. But I noticed we've in the past had slides around some of the penalties, and just you mentioned kind of the higher penalties for the misfiling or even not filing electronically. So, just want to remind folks that, I mean, you're talking about filings in the upwards of $100 per form, right? So, I mean, these are real, yes, there are some maximums, but you're talking about real dollars, where screwing that up can be painful.
You made me put that in the appendix, but in the deck that everybody's going to get, in the appendix, there's penalties by form if you don't file a 1099. So if you're listening to me and you're like, ooh, I'm just not going to file a 1099, they'll never know. Well, that's a really expensive thing to do if you get busted. So I wouldn't say that's a good answer, but file your 1099s, number one, big penalties. Number two, if you knowingly misclassify a worker and you dodge and weave a bit to avoid paying Social Security, that kind of penalty runs anywhere from $5,000 to $25,000 per mistake, especially if you know better and they can prove that you know better or that you should have known better. The fines and penalties are obviously most horrible for accounting people, because they expect us to know the rules. So they take this very seriously. The last thing, and then we're gonna kind of transition from maybe the compliance to a little bit of the policies and procedures and process. But the only other thing, because equity comp is our favorite, Jen, is around, if you do have equity comp out there, there is this thing called the 3921 form. Again, I think it's in the appendix, but, for anybody who's exercising incentive stock option, this is something that you have to then provide them a statement and file with the IRS. I will tell you, this form has been around for a long time, but unfortunately we still have, I'd say every year we have at least 1 to 2 companies that have never done it and don't know about it. So I bring it up. Not sure how many people exercise their options this year given the market volatility, but something to remember. And then the second piece is, if you're perhaps a public company or even a private company, if you've had any sort of liquidity event, meaning you had a secondary or some sort of sale where people were able to sell their options, you should be calculating the ordinary income around disqualifying dispositions. So that's something else to remember. Disqualifying dispositions being a sale of the incentive stock option share. So meaning I exercised my options and then I sold it within 2 years of grant or 1 year of exercise.
And then similarly, those rules apply to employee stock purchase plan ESPP shares as well. So that's more applicable to public companies, but we have a lot of folks on the line, probably from diverse companies. So always something to keep in mind are the 3921 filings, because again, the penalties are high, and also you don't want to have to go and fix an employee's tax returns or have them fix their tax returns kind of after the fact. So I think we're at our first polling question. So let's jump to the next. Let's keep going.
All right. So the first polling question is, if I pay Scott a fee to provide a service to my line of business and under my control, even if I never see him in the office. I'll give you guys a minute to answer. As a reminder, everyone needs to answer all questions in order to qualify for CPE.
Okay, right. So we're trying to figure out what makes Scott okay being an independent contractor. He barely shows up. He does work which isn't part of my business. He actually has a business. We talk about this a lot.
So,
oh, thank goodness.
All right, so 76% voted both B and C.
I'm so happy. Last year we didn't have quite the same passing.
Is that the correct answer?
That was correct. That makes me very happy. Okay, people are learning it. Let's move on.
Awesome. So we're going to kind of talk about some, so policies and procedures. And so, one of the things that we like to talk about, and year end isn't necessarily the best time to actually maybe draft all of these, but it is a good time to take inventory. Ideally, you have them already drafted. But we think about policies and procedures not as a, not as a let's just do them, put them in a drawer, and never look at them again, right? They should be iterative. They should be ongoing. They should be fluid to some extent. They should also hopefully de-risk your business, right? So that if somebody wins the lottery and decides that they are just doing great and don't need to work for you anymore, you're not left holding the bag. You don't know how to log into a system. You don't know how to process transactions. So, I mean, these policies and procedures, while oftentimes viewed as a sort of a pain in the butt, I would say, they're really to protect the company, and they can add a lot of value. Forget the kind of the SOX controls kind of framework of it. Look at it more from a business perspective and the benefits to the business. So, we think that the year-end timing, as you're going through and doing this kind of close, and really, as Jen said, you're looking at your balance sheet, you're looking at all your financials, you're kind of putting everything together. Now is the time to also take inventory. What do we have that is a solid process and procedure? What do we have as far as policy? So I kind of look at, there's sort of three different kind of categories, right? You have your accounting policies, maybe. So that's a high level. How do we account for revenue? How do we account for stock-based comp? When transactions occur, FX, exchange rates and things like that. Hopefully everybody has some basis of that, but again, maybe that should be documented a little bit better. Then we talk about, processes and procedures. And I think process is more high level, sort of almost a workflow. Hey, Scott's going to do this. Then he passes it off to Jen to do her piece, and Jen's the reviewer, and she's going to sign off on it. And then the last piece, again, which is not necessarily always required, but for certain technical processes may be super beneficial, is like more desktop procedures, right? So how do I actually go through, not that I send this to Jen and Jen does her review and then this gets approved, but how do I actually go in and run that report, or what do I do after I run that report with it in Excel and compare it? So that's kind of the sort of the three levels that we're talking about when we're talking about kind of policies, processes, and procedures. Again, you're not necessarily going to go rush and do this right now at year end. I can tell you we have a lot of clients that as they go towards a public event, so the SPACs, the special purpose acquisition companies, or IPOs, we have a number of clients that are having us race and try and do this as soon as possible. But what the big ask I think is here is take inventory, start to recognize where do we have missing data, missing documents, right? And where do we maybe have a process or a procedure that really only one person knows in our organization, which then creates risk for us. And then as you start to do that, you kind of say, okay, let's focus on the highest priority, and let's then build this into our 2021 kind of quote project planning to think about, okay, yes, we have 5 policies documented. We have 2 that aren't documented. We're going to look to get, this policy documented, in the first half of the year and the other one in the second half, or whatever it might be.
You know what, Scott, while you're talking about accounting policies, we should not fail to mention that HR policies need to be updated now. There are so many new HR labor things happening, partly due to COVID, but partly because of what was already there. And usually people try to roll out new handbook policies and update them around the first quarter at the latest. And a lot of HR teams should be working on this now. And it speaks directly to what you're talking about in terms of risk. Any people-related policies will de-risk the business, and it directly impacts your financials, your insurance policies, and all of your numbers. So put that on the list. Make sure that your team is up to date on the latest labor regulations.
Yep. No, 100%. I think that's right, Jen. And we're definitely talking about risk, and just doing things that kind of help streamline the business, right, and have it. So again, we recommend and happy to if folks have questions or thoughts around, hey, what am I missing? Happy to provide more insight into the policies we see. It's going to be kind of business dependent. We are very practical in our approach in the sense that let's not create a policy around every little accounting thing. Let's dive in and let's do the things that are going to be most important, most impactful. When we talk about infrastructure planning, now we're talking about our systems, right? So again, in the same process as we're going through and doing our year-end close, let's talk about what are we doing manually? What are we manually pushing from one system to another? What it just really isn't getting us the data we need, and we're ended up having to do it all in Excel. Or maybe it has the data we need, we just haven't, done training or custom reporting or things like that. So again, not that you're going to be able to solve all of those things now before the end of the year and the close, but you're working on it now, and now is the time to start to think about it, to create your 2021 kind of wish list, to say, hey, we go through this, we did this last year, we did this year. If I could just integrate, whatever, Intact and Bill.com, right? For example, and I know that's all kind of flowed through, and you can have your bank recs and all that. But if I could just have this done, then it would save our team, hundreds of hours maybe, or tens of hours, right? And again, maybe there's still time to do some of that stuff and really recognize the return on investment. But maybe some of that, again, is 2021 planning and as part of that process. The other thing is, right, most companies have gone through their budgeting, right, and planning process for 2021, right, as a strategic perspective, right? I think then the next piece is, yes, these are all of our strategic things, but what are the infrastructure investments that we also need to be making as part of this process? So you on this call may or may not be the influencer into those things, but you are an influencer in the sense that you can raise your hand and tell somebody, hey, if we had this connector, or if we had this custom report, it would save me 5 hours a week or 10 hours a week or whatever. Let's not be afraid to, I think there's sometimes this fear, well, if I'm doing this manually and I save 5 hours a week, well, I put myself out of the job. Well, no, you get to do higher level, more value added items, and maybe even items that are more interesting to you, or, you can continue to grow in a different way. The next piece is kind of this, year-end mini audit, and Jen sort of alluded to it, right? Your balance sheet sort of being a checklist. You know, if you are a company that does get full audit or review, doing year-end kind of process and going through and making sure that your numbers tie out and doing this kind of year-end mini audit is going to be super powerful. It's going to just make your process as you go into 2021 more streamlined. Your auditors may already be doing interim work, so again, you might already be doing this as part of your process. I would say the next thing is, are you in the cloud across all of your platforms? You know, this is still something we find from clients that they're on legacy platforms, outdated, not maybe even no longer supported. And so, again, you're not going to upgrade as part of your year-end process, but it's something to think about as part of planning. And when we talk about the cloud, it's not just your core systems. It's things, and many of our clients have struggled with this if we think about the impact of the shelter in place. It's not just like your core accounting systems and your infrastructure systems. It's things as much as document management, right? Or contract compliance, right? And contract management, all of those things, right? AP processing, AR processing, being able to collect checks or submit money, right? We talk about the cloud, right? But that's, we are, we got to think about it from a holistic perspective of being a remote employee. So let's jump to the next slide, please. Again, not going to go through these necessarily in detail, but these are key areas where we would expect to maybe have some more detailed procedures. And these are kind of the main areas of risk we find: order to cash, procure to pay, record to report, planning, treasury, acquire to retire if you have fixed assets, or inventory. And then I think the thing to kind of consider here is there an opportunity to automate, right? So we don't have a specific slide around a robotic process automation, which RPA, and a lot of people are a little bit afraid of what does RPA mean? Well, I mean, RPA, it means whatever you want it to be at your company, at your level, right? So what we're finding, yes, if you're a Fortune 100 company, RPA may mean something very different than, if you're a 100-person company and you're doing, 10 or $15 million in revenue, right? There's still an opportunity for automation, right? So I think oftentimes our smaller clients think, oh, RPA is for those big guys. That doesn't apply to me. No, automation applies to you. And there are some really slick, easy wins, again, really around AP and AR, specifically if you have a high transaction volume. Let's jump to the next slide. Some of the items around equity, which is my forte, is just evaluating your assumptions, right? So again, as part of that audit kind of checklist process, what are your assumptions? Have your peer companies changed through the year? Are there items that you need to update? For any of you out there still applying a forfeiture rate on your stock-based compensation, just get rid of that, maybe. I mean, there's no need for it. It's a pain. Your auditors have to review it. You have to calculate it. I'd say we have maybe less than 5% of our clients that still do it. But that's something that, again, as part of going into 2021, we'd recommend getting rid of. And then, of course, completing any of your year-end calculations. A lot of our clients do stock-based compensation once a year. A lot, I would say maybe many of our clients, maybe not a lot. We have more and more clients kind of doing it quarterly because they want to have, sort of GAAP compliant financials or just have it all inclusive. But if you're doing it as part of year-end process, start on that, right? Yes, you need all of the activity through the end of the year, but you can potentially get started ahead of year end to accelerate your close. If you're working with us and we, help you with your stock-based comp, and we haven't reached out to you, we will, but reach out to us because we're happy to help you and get you in our queue, because we do help a lot of clients at year end. So that's, working with them in their systems, managing their platforms, and doing all the stock-based comp calculations. The last thing on this is if you had any transactions, so unique transactions, secondary transactions, and the like. So we've seen a lot of tender offers and secondary transactions. Those are things that you want to look at very closely, because, and especially the tax side of it, because solving them or relieving them in 2020 before the calendar year turns, or even before April 15th in some cases, can be huge. So if you had any unique transactions, where you're unsure how to do the taxes, or maybe you didn't treat something as compensation that was a gray area, again, highly recommend that you look at it again before the end of 2020 and solve it. Maybe you have to reach out to people to withhold when you didn't withhold previously, but doing all of that within 2020 is going to help you tremendously before the calendar turns. Let's go ahead and jump to the next slide. So I'm not going to go through these in details. This is a little bit more of a takeaway slide, but I would say these are kind of the top areas where we recommend kind of in preparation for the audit, right? Kind of part of that mini audit is looking at all of these areas specifically and diving in and, kind of trust your systems, right? If you're using systems, you have to trust them, but also doing sampling to verify the data. So, and then beyond the balance sheet, I think these are important, especially, we talk about during COVID with dispersed workforce, having controls, having disaster recovery plans, et cetera, are really important. So, Jen, did you want to chime in further? Otherwise, we're going to move to the next polling question, I think.
The only thing I would say there is that, Scott, you're a fan of using this time of year to also do employee education. If you do have equity compensation, ISOs, things that are fancy, a lot of times employees don't understand them. And so Scott talks about educating your staff about the total value of their compensation package, which can add to your retention, employee satisfaction. People forget they make a lot more than just their base salary. And even a basic employee, there are things that you can do where you send them a statement that says, here's the value of your medical, here's the value of your 401k match on top of that, and so on. And so this might be the time of year to think about that kind of communication to your staff as well.
Yeah, thanks for the reminder, Jen. I wrote it down. I forgot to mention it. Yeah, we actually, right before this presentation, I was just doing an employee education session for one of our clients. So we do those around equity comp. We do them actually around all benefits. And I think the key thing, if it's around equity comp, I recommend doing it before the year end because it may impact how people tax plan. If it's more general around the benefits, holistically, you might do that as part of your 2021 kickoff, get people rallied up. But the one thing I want to reiterate to Jen's point, it's not just like, oh, we did open enrollment, we told people, but open enrollment is very specific to certain benefits, right? You as a company holistically have a number of benefits, right, that maybe aren't necessarily just related to open enrollment. And so that's where when, even the statement that kind of gives you your total benefits like Jen talked about, I mean, that's where it can be really powerful. Or just having a refresher on, hey, these are all the things the company offers. Did you know that we have whatever stipend food credits, or we were joking before the call. You have a Drizzy subscription that gives alcohol to the employees once a week or whatever, right? I mean, that's all benefit that you want to highlight, right? And showcase. So let's jump into the polling question here. What is the biggest challenge with your year-end close process, right? So reconciliation between systems, concerns over accurate data, not sure how to deal with 100% remote year-end close, which for the first time many of us are going through, being audit ready, or hey, you got it all covered, you have no challenges. And you can, I was going to say, I thought it was a select all that you can select all that applies, but it doesn't. It's just to select one because we're looking for the biggest challenge. You may have a few challenges, but this is the biggest challenge.
All right, so 25% said reconciliation between systems and 39% said being audit ready.
If you were saying that you have reconciliation between systems things, think about what Scott said about checking your systems and using technology so that you're not having to reconcile, so that they're talking to each other. That's something we hear quite a lot. We have a strategy team here that helps people set up technology that talks. So you think about how much time you're spending on that, and maybe you can save yourself a little bit of sleep time.
All right, let's go, Isaac. Carry us home.
All right, we'll do that. As we move into the year, there's a couple of things that we want to make everyone aware of from an accounting standards update standpoint. The FASB came out in June in response to the COVID crisis that was happening, and essentially deferred the big three accounting standards that were looming out there. So let's jump to the next slide. So revenue recognition, ASC 606, several companies have already adopted. I would say probably the majority of our clients have already adopted this, but for any company that had not issued their financial statements prior to June 3rd, the FASB gave them an additional reprieve from having to adopt and implement the new standard. This will become effective though at the end of this year, so there are challenges that have to be faced with that. There was a reprieve from last year. ASC 842, the lease standard, this was kicked back another year to December 15th, 2021, so effectively for calendar year 2022 companies, and then the new credit loss standard has been pushed back effectively to 2024 for privately held companies. Let's go to the next slide, polling question.
All right, polling question number 3. So true or false, W-2 filing penalties can exceed $3 million. All right, looks like you guys are paying attention. 72, oh, well, no, hold on. 68% voted true.
Yep, that was not a trick question. That is just a frightening stat. You get fines per form, and then you get fines that grow if you're 30 days late, 60 days late, you have till August 1st, and then after that, you're just out of luck. And there are limits on companies that bill less than $500,000, which is not a lot of companies. Everybody else is subject to huge sky-high penalties.
Definitely something you want to get taken care of. So as we move into the end of the year, we've already touched on doing a mini balance sheet audit and making sure that things are lined up and ready to go for the year-end close process. But this year in particular, because of the challenges that COVID has brought to all of us, there's some things that we want to make you aware of or to highlight as we close out this year-end webinar. These are things that specifically relate to financial accounting and reporting and any audit needs that you may have. The first is impairment. So the standards require that both tangible and intangible assets have to be evaluated for potential impairment indicators. Because things have been changing so rapidly and there's challenges around trying to forecast future cash flows, impairment is one that you want to get ahead of as quickly as you can. I'm working with several clients right now on this issue, talking about what they need to factor in and consider from an audit standpoint as they identify impairment and or quantify any impairment amount specifically. But there are significant challenges here because things have changed so much from year to year, and looking at things as you have in the past may not be relevant for what you're doing today. Estimates. So if you look at a set of financial statements, there's estimates throughout balance sheet, income statement, across the board. There's estimates that management has to make as part of the financial reporting process. And as we come into the end of this year, the way you've done it in the past may not be enough to accurately form your estimates this year. It's difficult to determine kind of what the new norm is, both this year and kind of going forward, especially if there's been challenges related to customers or supply chains, products and services, and whether or not you'll ever really return to pre-COVID operations. Some companies are planning to use the 2008 financial crisis as a benchmark or starting point for the challenges of this year, but that may not be relevant to what's happening today. So just be cautious of how you're forming those estimates. You may have to look at things from several different angles, and you may need to pull in more third-party data than what you've had to do in the past. Modifications to contractual arrangements. So
Hey, wait,
sure.
I have a question. When you say estimates like that to someone like me, so I'm an operating accountant, I'm not technical like you. So
Sure.
I'm sitting here listening to you and you scare me. So when you say that to me, what do I need? What do I need to do to document my estimating process?
Yeah, the important thing is Scott touched on having your policies and procedures documented, and that's definitely a great starting point. But as you look at your financial statements, so for example, your allowance for doubtful accounts is oftentimes a big estimate that's made by management. You want to document what you considered when you formed that estimate. Right? Is it based on historical quantitative information, the company's own loss rates, and then have you applied quantitative factors to adjust for that? So, for example, if you have minimal losses in the past on your accounts receivable, but this year you know that your customer base is going through significant challenges, your accounts receivable are aging out even farther than they have in the past, you may have to qualitatively try and determine or estimate what you think those losses may be going forward. So the important thing is just to document what your process is there. And the overarching theme to all of these topics on this slide are talk with your auditors. If you have an audit coming up, talk with your auditors early in the process. Talk with your bankers, talk with the decision makers in the company. Communication is going to be your best friend as you work through this. Definitely not on an island. There are definitely people you can lean on and reach out to for support to help you through the process.
Got it.
Great question. As we touched on modifications to contractual arrangements, so if you've modified your debt agreements, if you've gotten a reprieve on making payments or interest rates or loan terms, there's potential accounting impacts from, is it a debt modification versus extinguishment? That does get pretty technical. And to Jen's point, don't want to scare anybody, but it is something you do want to work through ahead of year end because there could potentially be an income statement impact from that.
Similarly, Isaac, right? I would think, leases as well, right? If you
Exactly.
or rents, things like that, right? That all is going to have a potential impact as well.
Yep, absolutely. Things like contracts to purchase contracts and things of that nature as well. Anytime there's a modification of an existing contract, you need to evaluate kind of what the accounting impact is. And again, it does get pretty technical. But there are resources that you can reach out to for support there.
Yeah, we also saw many companies sort of that are subscription-based companies, potentially extend their terms, right? So instead of a 12-month subscription, they're actually giving somebody 15 months before they have to renew and things like that as well. So those are all things that are, unique and again, modifications of contractual arrangement that you want to consider.
Yep, absolutely. Last couple of bullet points here, government assistance. So the CARES Act provided us multiple different avenues for companies to get financial support through the Payroll Protection Program, tax credits, grants, kind of a variety of different options have been made available. There are accounting impacts for each of these, and the rules, unfortunately, have been changing sometimes daily on how to account for these transactions for forgiveness, for not forgiveness, interest payments.
Right. The number one thing there is that people need to be planning for tax on that, right, Isaac? It's
absolutely, yes. Yep, that's a great point. Make sure you're talking kind of with your tax accountants on what the potential impact here are. Don't want to be surprised by this later on. And again, the guidance has been changing in some cases daily.
Sort of. It's like what we talked about this. I just did a webinar on this with a labor firm recently, just this morning. A lot of people were trying to kick that down the road. They thought they could kick the taxation on, for example, the PPP loans down into next year. But that was never really a viable option. While they have confirmed their stance, they were just confirming it and saying, yeah, we mean it. You're going to have to not deduct those expenses. That's the way they worded it. It was out of weird sides of their mouths. But the bottom line is it's taxable, this government assistance, and it's taxable this year. It is not taxable next year. So if you're in that predicament, you need to work on your PPP forgiveness and just start working with your tax person now and making sure you pay tax estimates on it. And if you don't, you at least know it's there. As Isaac is saying, don't be surprised next year about that.
Exactly. The last 2 points here, going concern and subsequent events, kind of evaluate these together. But several companies this year round are going to have to look at going concern where they may not have had to in the past. Management has to evaluate whether conditions and events, whether by themselves or combined with other issues, present doubt about the company's ability to continue for a period of more than 1 year after the financial statements are issued or they're available to be issued. The big thing that's a challenge here are cash flows. So estimating those future cash flows and coming up with accurate estimations can be a challenge, particularly in light of just the uncertainty that's out there from an economic standpoint, whether it's your own company or industry-wide. There are just challenges in trying to ascertain what's going to happen in order to estimate those cash flows. Again, to Jen's point earlier, big topic here, big point here to take note of is to make sure that you're just documenting what your considerations are. You know, if you have supporting documentation, awesome. If you have a thought process that you went through and then that you've discussed as a management team, document it. You know, put a memo together that outlines what that thought process was, and if you have quantitative data behind that, those cash flow calculations, all the better. The auditors are certainly going to be asking for that, and definitely something that you don't want to wait on until the last minute. And lastly is subsequent events. So if the things that happen after the end of the year, before the financial statements are ready to be issued, are there topics out there that have to be transactions that have come up that need to be recognized or disclosed in the financial statements? A good kind of rule of thumb and something that I would add to kind of Scott's year-end balance sheet check, well, you can't do it ahead of year-end. I mean, it's a great point to have is to keep a list of transactions, significant transactions that have come up after the end of the year. And make sure you're talking with your audit teams and your management teams, sometimes bankers, depending on what the nature of the issue is. You just don't want to surprise anyone with things that have come up. And so that way there's not last minute adjustments that have to be made in order to recognize or disclose any subsequent events.
Yeah, I think the other thing on that, again, I don't know how many public clients we have or public companies we have on this, but you know, the SEC is kind of, and I think it's similar to the framework we should be thinking about with private companies, right? But you know, in thinking about the risks to the business, the SEC has kind of come out and said, you know, don't over sort of exaggerate the risks related to COVID, right? Like be more practical and precise and tangible. I think companies were starting to have, you know, a lot of vague, sort of broad-based, less meaningful kind of risks that were being put into financial statements. And so, you know, when we think about
boilerplate disclosures and things,
right, exactly. And so I think, you know, we don't necessarily have those same disclosures as a private company, but again, thinking about the risks and how we talk about them in our financial statements, I think an important piece, and even subsequent events and things that are happening, I think the important piece is to be tangible, be real, right? You know, understanding the impact kind of more directly and specifically. Of course, the future is unknown. There's still many, you know, changes and evolutions to this pandemic, but you know, be a little bit more, I think, practical and tangible, I think is our recommendation, and I think that's what the SEC has kind of come out and said as well.
Absolutely.
I hope people answered this while you guys were doing that. Nyla, do you have results already?
Yeah, so 30% said Q1, 23% said not audited, 19% said Q2.
There you go.
Q1 is upon us. It's around the corner.
It'll be here before we know it.
Yep. I think that wraps it up, guys. We have 2 more minutes. Yep. Nyla?
Yep, let me see.
Do we have any questions in the chat?
Yes, hold on.
No, I think we're good. We've answered them.
Yeah, a lot are mainly just as a reminder, you guys are going to be getting the recording within 48 hours, and as well as the payroll checklist that we talked about, and then your CPE certificate within 5 business days. And then again, if you guys have any additional questions, feel free to email the presenters at the end of this presentation. Thank you guys so much for joining, and have a wonderful day.
Thank you.
Thank you.